So continuing with leases here, we've got IFRS 16 covering leases. Now this is a brand new standard. In fact, as I record this, it's about 5 days old. When this comes into your exam, it'll be 2019. So at the moment, it's purely awareness only. There'll be no direct questions on this standard. But the examiners always tell us that if you were to bring this up in a question which was covering leases, and you talked about the future issues of accounting for leases, then that would definitely be worth a couple of marks in your exam. So it shows a bit of awareness. So it is still important. It's an easy couple of marks as well. It's a lovely little standard, this. So the reason why there's this whole new standard and why it was issued is under the old IAS 17, which is still in force until January 2019, but entities were able to classify a significant number of liabilities as operating leases and keep both the asset and liability as a result completely off balance sheet. Now this would hamper comparability when comparing one company to another, if one had finance leases and one had operating leases. It could hide the true gearing of a company, because a lot of this debt they would be obliged to have to pay for, but it's not on the financial statements. So there was a fair few problems here. So IFRS 16 comes into play, and it says that most leases to be recognised as assets and a liability. Now most, we really are talking about 99.9% of leases. There's a little exception right at the bottom of this page. But this is all to do with leasing accounting. Anything to do with lessor accounting is still going to be in reference to IAS 17. So IAS 17 is now going to only cover lessor accounting. So firstly, when you enter into a lease, you've got to see whether you have got a leasing arrangement, and therefore you should be recognising an asset and a liability. And you can identify whether this arrangement exists by looking at the contract itself and seeing if the contract conveys the right to use an asset for a period of time in exchange for some consideration, usually cash. Now, there's a key term in there, this idea of, does it give the right to control the use of an asset? So this idea of right to control means that the customer can direct the asset as they see fit, use it as they want. They've got, in other words, the risks, the rewards, the control of that asset, and as a result they can get the economic benefits of the use of that asset. So in other words, any money that asset generates will flow to the lessee. Now, once you know that you've got a lease, you then need to put it in your financial statements, which is our initial recognition here. So the lessee should recognise the right to use that asset, effectively up in non-current assets. And then they need to recognise a liability as well on the statement of financial position. Now, these should be measured at the present value of the lease payments over the lease term, and these payments should be discounted at a rate implicit in the lease. Or, if there isn't a rate implicit in the lease, the company should use their incremental borrowing rate in order to establish those present values instead. Okay, so let's put that into context. Let's say that we entered into, I've got a bit of room here, see if I can squeeze it in down here. Let's say we entered into a lease. This lease runs from immediately, where we're going to pay £100 at the start of the year. At the start of next year, we're going to pay another £100. At the start of the year after, we're going to pay another £100. At the start of year 3, we're going to pay another £100. And then the lease ends after year 3. So we'll consume the asset in year 3 and then either give it back or scrap it, whatever's going on there. Now, let's say in a question they tell us that the rate implicit in the lease is 5%. Now, if there wasn't a rate implicit in the lease, then we would have to consider our incremental borrowing rate instead. But assuming we've got a rate implicit in the lease, and that's 5%, or you could say it's our incremental borrowing rate is 5% if that wasn't in existence. What this would require us to do now is to discount those sums of money payable into their present value in order to recognise an asset and a liability. So £100 payable today is worth £100. The £100 payable in 1 year's time, we would need to discount this by timesing it by 1 over 1 point our discount rate to the power of the number of years, which is 1. the £100 payable at the start of year 2, we need to discount that as 1 over 1 point, the interest rate, 5%, to the power of 2 years. So you might remember this from your FM studies. And lastly, the amount payable in year 3, 1 over 1 point, the interest rate, which is 5%, to the power of 3 years. Now, in doing that, we'd end up with £100. To that £100, we'd have to add £95.2. We've got in year 2, 90.7. In year 3, that would be 86.4. And when we add all that together, we now have the present value of the minimum lease payments. So by adding all 4 of these numbers together, the amounts payable, we've got the present value of the lease payments coming in at 372.3. So that would be our start point for our initial recognition. Based upon this figure, we would go about debiting PPE and we'd go about crediting the lease liability with this figure. But there is a little note here. If when we enter into a lease, we've got any direct costs, we should capitalise any of these direct costs like legal fees also. So sometimes the PPE won't agree to the lease liability exactly, that has been capitalised, because we may have had some legal fees, so we would debit PPE with those legal fees, let's say they were £10, and credit our bank account because we've paid those legal fees with £10. So any directly attributable costs affect the actual asset itself and have no impact on the liability. Okay, so there's our first part. Once we've recognise that asset, we then have our subsequent measurement. Now, with subsequent measurement, we've got 2 things to worry about: the subsequent measurement of the asset and the subsequent measurement of the liability. The subsequent measurement of the asset, so our asset would be currently recognised at 382.3, being the £10 plus the 372.3. So we've got 382.3, and that needs to be, well, if you've capitalised it as an asset under IAS 16, we should go about depreciating that over its useful life, reducing balance, straight line, your choice, as what IAS 16 gives you. If this asset falls into a class of assets that you revalue, you should actually then revalue that asset as well. So if that asset is a building, and it falls into a class of buildings, or it falls into buildings and you revalue your buildings, then you should revalue this building as well. And the logic of that falls in IAS 40 as well. So if this asset, although you are leasing it, you decide to then lease it out to somebody else under a finance lease. So if you're doing that, then you should go about applying IAS 40, whereby you either depreciate it or you revalue it through the P&L account each year. So it depends upon what your accounting policy is for the class of assets where this asset actually falls to. The liability, a little bit more fun. The liability is going to be slowly paid off over time, but we will need to go about accounting for the interest on that liability using the method called the actuarial method. So that might work. Let's play with that liability just to demonstrate at the bottom here. We've got year 1, year 2, year 3 and year 4. We're consuming this asset over 4 years. Year 1, we've got our opening balance liability of that asset, which we said was 372.3. That would be our opening liability. Immediately we repay £100, taking that asset down to 272.3. At that point, we apply the interest at 5%. 5% of 272.3 is 13.6. That's going to go to finance costs, and it will increase the lease liability as well. So we decrease the lease liability through the repayment and increase it with the interest. Double entry wise, as you know, when we go about accounting for that repayment, we'll debit the liability. So I'll put there let's just call it liability, the lease liability, and credit our bank as we pay the money out. And with the interest, we'll be debiting finance costs and crediting the liability, making the liability bigger every single year. So our closing balance then would be 285.9, I think. That would be our next year's opening balance. So next year, 285.9. Take off our repayment of 100. That takes us down to 185.9. We then got interest at 5%. 5% of 185.9 is 9.29. Closing liability at the end of year 2, 195.2. Then we go again in year 3, 195.2 brought forward, £100 paid off, takes us down to £95.20. Interest at 5% gives me about 4.8. Closing balance 100. Next year, opening balance of 100. Take off the repayment of 100. We've got no liability outstanding through the use of this asset. We can now consume this asset through this year, and there's no liability attached to it. That would be if you paid up front at the start of the year to consume this. If you paid monthly, then of course there'd be a bit of interest in the year as you slowly pay that off. Now, something to note here is how, by applying this new approach to leasing, you end up by recognising quite a significant cost for interest in the P&L account in the early years, and that interest cost gets lower over the lease term of that asset. Now, this is obviously a big difference compared to the current approach to operating leases, where you would recognise an expense on a straight line basis. Now we're having really big expense in the early years and small expense in the latter years. You could also look at that on the basis of depreciation as well. If you take straight line depreciation, then it's going to be a straight line depreciation, a straight line cost. But if you take reducing balance, it's going to be a significant cost in the early years and a lower cost in the latter years of that rental. So again, different to your operating lease standard, where you used to, or you currently, go about recognising expense on a straight line basis. Okay, so we're reiterating that just here. Interest will be higher initially as the liability is higher, and potentially your depreciation could be higher initially because you may be taking a reducing balance approach. Very different to our current approach. Lastly, there's a little bit of exemption criteria here that a leasing may elect to account for a lease payment as an expense on a straight line basis through the P&L account if the lease is short term, so 12 months or less, or incredibly low value, so you're hiring a PC or a piece of small office equipment. It's not material to be able to account for it in the way that we're describing here. It would be no cost benefit in doing it, so it falls back to the framework somewhat, I guess, that. Okay, so I think it's a great little standard, that IFRS 16, very, very sensible. Hopefully you enjoyed that one. I'll be chatting to you again real soon, I'm sure. All the best for now.